Good afternoon, everyone. Welcome to our mid-year, I should say, update. I'm David Scherer, Co-CEO, Origin Investments. I have to play this, so I will. This is our disclaimer. We've grown and now we're a bit more regulated, so please read and let us know if you have any questions about that. I've added this slide because I oftentimes include this, but it's late in the webinar and the Q&A, and I want people to understand that I'm accessible. That's why I'm listing my email. If you're a client of Origin, we have over 4,000 partners at this point, and you have a question about any fund you're in or real estate in general, you can always contact me. And I'm pretty accessible. I'll make time in my schedule, or we have 60 professionals, and I can also direct you to people that can answer the question perhaps better than I could. I wanted to tell you briefly this morning, we have a client in Florida, and he's a friend, and his son has been in the armed forces. He's a major in the special forces for 13 years now, and he wants to start a business in real estate. And I spent, an hour with them. In this case, I wanted, I want to give back. But also, I want to help a client, and it was just wonderful to do. But it's just an example. It's something that I'm personally committed to. So keep that in mind. In terms of the webinar today, we are only going to be about 30 minutes, and so I don't have a ton of slides. I will go through them. We had about 20 questions emailed in prior. Some of the same themes. I'll cover some of them in the slides. I'll address some of them directly in the Q&A. The Q&A, I already see people are using it, so please use the Q&A feature at the bottom. And we also have a survey that you can see in your toolbar. It's 2 questions only, so if you have feedback, we really appreciate your feedback, and many of you give that, so thank you. The last thing I'll say is, if you're a client, you received information yesterday on Origin Exchange, which is our new 1031 platform. We will be having a webinar at the same time next week, Thursday, 1 p.m., and my partner, Michael Episcope, and then our head of that product, Mike O'Shea, will be presenting. This is something we're really excited about because we think it's a very inefficient market where people are often taken advantage of, and we want to change that. So if you have 1031s or are interested in learning about it, that's next Thursday at 1 p.m. Okay, so just to frame this entire webinar, each year, in this case I'll say I, but it's Origin, but in this case it's me. I believe it's for the last 4 years I've written an end of the year article where I make predictions for the next year. And one of our professionals, Barbara, in marketing, a few years back said, well, why don't we also write another article that grades your predictions from the year prior? And so usually those come out in November, December, where we have one article where I'm grading my predictions, and then the second is the new predictions. And so these were made in November of 2023, just to give you an idea of it seems like a long time ago now, but it wasn't. This is right after the Federal Reserve and Chairman Powell said, we're probably done raising rates. And then the markets immediately assumed they were going to cut rates 6 to 8 times. And there was a lot of euphoria, and interest rates went from 5% plus or minus in the 10-year note to about 3.8. It's a pretty large move down. And so I just want to give context of the environment I was writing this article. And about a month ago, Barbara came to me and said, given that everything has really turned out to be very different than the expectation, does it make sense to do this mid-year and have a mid-year update and sort of grade what you talked about, and also, anything that's changed in your opinion. And so that's why we're doing this. So I will start, and I see that I'm already 5 minutes in. So my goal is to be done by 1:20, and then we'll jump into questions. So the first prediction I made was that interest rates will remain high. And at the time, that was very much against the grain, against sentiment. because interest rates had just come down quite a bit. There's a lot of euphoria. Um, and by the way, let me just say, interest rates remain high relative to the last 10 years. That's we have to be mindful of the fact that 10-year note yield today is, I believe it's 4.37. That isn't high, but it's high relative to sub 2% where it was in 2021. Of course it's high, but it's not high when you start to look at longer term rates. And I also want to be clear, multifamily investing can do very, very well in a 4.4 interest rate environment. What's been difficult is the doubling of the risk-free rate in a very short period of time. And so I believe interest rates will remain high. I want to reaffirm that. But that means that we're range bound. And I'm going to move to the next slide to kind of show you why a little bit. If you look at the blue, that's our inflation rate. And obviously, if you look past where we are today, which is kind of April 1st, that's my prediction. That's where I think it's heading. So if you see it kind of flatline the blue on the right side of this graph, I believe inflation, which is right around 3.5 now. The report yesterday was a bit benign, but PPI the day before wasn't. I think we're going to stay right around 3.5. There's enough things that are deflationary and there's enough things that are inflationary. If you believe that the real return on investment should be 50 to 100 basis points, which it has been for the last 15, 20 years. Prior to that, it was even higher, meaning the nominal rate has to be a spread over inflation, because if you buy bonds, you want a real return, which is the nominal rate minus inflation. Because my belief is that inflation will stay at around 3%, meaning stickier than what the Fed wants, and I also believe the real return needs to be 50 to 100 basis points. That's where I get my range, which I think the nominal rate should be 3.5 to 4.5%. Right now, we're at the higher end of that. We're at 4.37, but I think that's a reasonable rate. I think 4 is a reasonable rate. That's where I'm getting my assumptions from. And so you as an investor, because I don't pretend to know the future, it's just my opinion based on data, you need to ask yourself that question. What do I think inflation really will be going forward? I can tell you that there should be a 50 to 100 basis point spread of the nominal rate, and you can make a sound decision on your own interest rate outlook. But I just want to stress, a 4.5 interest rate, even that's the highest end of my range, multifamily does just fine in that environment. What we need is interest rates that don't fluctuate so much. And I also believe that that's going to happen. I don't think that we're going to see massive fluctuations. If you think about the last move highest in yield, which was October of 2023, it went up to 5%. This time it went up, the high point was 4.67. And so in other words, it's making lower highs. And I also believe it's going to make higher lows. And so we're looking at a lower volatility interest rate environment going forward, which is good. The second thing I want to stress is this again was a prediction made 6 months ago. New multifamily development will come to a standstill. This has actually been happening for the last 6 quarters. I talk about a lot in webinars. It's still happening. There's an economist I follow. His name's Jay Parsons. He was out on LinkedIn today talking about this discrepancy between existing supply, like supply that's coming on market right now, that was started 3 years ago in this low interest rate environment of 21, versus new starts. And that's the largest discrepancy since 1975, meaning there's a lot of units being delivered right now, and there's almost none that are being started. And so I'll talk about this more, but it's one of the many reasons that I believe that multifamily fundamentals are incredibly strong looking forward, which you have to do as an investor, right? You can't look at today's reality You need to look at what would next year look like, and the next year, and the next year. I believe that reality is very strong. And part of it is based on very low supply that will be coming as we get further into the 2020s. So here it is, historic completions, then a steep decline. If you look at the right, it really tells the story. 644,000 completed units. In 2024, that's the highest level since 1974. That's a lot of units, okay? But if you look below, 43.7% decline in multifamily starts year over year from 23 to 24. That's extraordinary. And I'll cover this on a later slide, but we already have a housing shortage. And so I know some of you heard this metaphor before, but it's the snake eating the elephant. The snake's hungry, he eats an elephant. He's very full. But then a couple weeks later, he needs another elephant. There's no next elephant. There's just the 644,000 that are coming now, and then it starts to decline, and then it declines a lot. The snake's going to be really hungry in 25, 26, 27. That snake is a renter. And those renters are going to be encountering higher and higher rents because there's going to be a supply-demand imbalance, in particular in our growth markets that have continued to show extraordinary absorption throughout. And so, that is the thesis. And I'll get to, I'm not saying much unique right now. Some of the people that I really respect, our competitors, are also saying and importantly doing similar things. And I'll touch on that in a moment. Elevated multifamily valuations have mostly corrected. So this I did change a little bit because when I was writing 6 months ago, I was indicating that multifamily valuations had further decline, and they have, probably another 5% in that 6-month period. But I think that I'm not going to call a bottom, and I don't tell you the future. I always talk about distributions. But I think it's more likely that we have an upside, meaning values will go up, not down from here. I think it's more probable. And I also think that this is a time where you should start accumulating multifamily. And my partner Michael and I talked about this on an Income Plus webinar maybe a month and a half ago. This is a time where you should be reallocating back to multifamily. And first of all, it's an asset class that's very low risk. It's an essential consumption. It's had extraordinarily high returns over long periods of time. It doesn't tend to correct much in a recession because the cash flows are very stable. People need a place to live. I don't think that it's disruptible by technology. You have a fundamental need for housing. I don't think you can say that about any other real estate. It could be disrupted. So I love this asset class as a secular investment. And now you have an opportunity to buy it at valuations that are much more attractive than they were 12 months ago, 18 months ago. So at this point, I think that this is addressing this slide. Why would we be nearing a bottom? Well, the first bullet is, and if you look at the right, the multifamily indexes, it peaked in Q1, Q2, 2022. That was right when the Fed started raising rates. And then it's declined, and now it's starting to flatten in that decline. And so now where is it going in the future? I'm very confident that just as a stock market, if you go out 10 years, it's almost always higher. I also believe the same thing about multifamily indexes. If you expand it or even move it to the left, it just has an upward slope over time, and that's the dotted line. Higher cap rates, in my opinion, will be offset by rent growth. I think that the demand is still there for housing. Part of that, and we'll get into this on the next slide, is fueled by the enormous disparity in the cost to own versus the cost to rent, which keeps growing. And then the other part is it's an essential consumption. And so if you buy a cap rate and you're able to raise rents over time, you're obviously building your cash flow. The second bullet is operationally. I believe we reached the bottom. I don't see that there's supply shocks that can increase your expense ratios in the way that happened in the last year and a half. Most importantly, insurance. I don't expect insurance to go lower, but I also don't expect it to be growing at the rate it has. I think it'll normalize to the old growth rate. And so then what you have is, as rents grow, high NOI margins. Now, the big caveat, and this is why you go all the way back to the first slide, if interest rates, if the risk-free rate were to go higher, then our borrowing costs go higher, and then our cap rates tend to follow. And so when I'm looking at these three bullets, I feel strongly about bullet 1 and 2. I also personally believe that interest rates will stay in and around these levels. I said as much. So I don't see that upside dispersion as I did before. And if you were an investor 2 years ago, I was talking about how I saw interest rate dispersions to the upside. And importantly, we hedged them. We didn't just talk about them, we hedged them at that point. I don't think that that same risk is there today. So in terms of distressed opportunities, and I'm going to speed up a little bit because I'm 17 minutes in, but there are distressed opportunities in the market. The reason we haven't done many of them yet is they tend to be in lower quality assets in lower quality locations. And that doesn't meet our criteria. But we are starting to see a few in our target markets of higher quality, and I'll speak to one. I have to be a bit vague because it's off market. I also believe that this will be a very short-term opportunity. I don't think that this distress cycle will last 2 or 3 years and you'll have all kinds of time. And the reason is the secular story is too strong. And so the opportunity is being created by assets that were purchased at too high of a price, leveraged with too much cheap variable rate debt that then wasn't cheap because it was priced over LIBOR, now SOFR, when it was 0 or close to it, and now it's 5.25. So that 300 over loan that used to be 3% is now 8.25, and the properties can't support that type of debt load. They also overpaid for the property, and so that's what's creating this opportunity to buy. And you have to be quite careful because just because a property's down 20% in value doesn't mean it's a buy. You know, it could be that the last buyer just made a big mistake and it's still overpriced. So multifamily market fundamentals will strengthen. I covered that. I just want to go into a little bit more detail. And I'm going to focus on the right side of the slide. Although bullet 4 I haven't covered. Multilytics, our own AI platform, which we've built for about the last 4 years. At this point, it's bringing in about 5 billion pieces of data a month. And it's been incredibly accurate about rents, including the huge rent increases in 21, the flattening of rents in 22, predicting negative rents in 23, which almost never happens in multifamily. We published that in Q4 of 22. So we're on the record and we were right. It's predicting that we've reached the bottom in the rent correction cycle, and we're going to start seeing rent increases into Q3 and Q4 this year, and then they're going to strengthen in 25 and 26. Intuitively, I also believe that, and I covered as much. There's not enough new supply after the wave of supply, which was caused by the 21 low interest rates that's coming, and the demand is still there. Why is the demand there? I challenged our research team because there's so many different numbers thrown around in the housing shortage numbers. And so I wanted you to see this disparity across Moody's, Realtor.com, Freddie Mac. I would say Freddie Mac is probably the one I would trust the most, But that's a massive dispersion, right? You're talking about, are we underhoused by 2 million or 3.8 million? The point is we're underhoused. And the next point I want to make is not only are we underhoused, but there's almost no new housing starts in multifamily happening. And so this is going to get worse. That's the snake looking for the elephant. Already underhoused, no next elephant. Cost to buy versus rent. This is extraordinary. And it shouldn't be surprising. You know, rents have been flat, but the cost to own a home keeps going up because home prices aren't correcting. But mortgage rates have gone up a lot, obviously. And, you know, they're north of 7. And some of your other costs like insurance, property taxes also are going up. So, you know, if you just kind of take the midpoint there, it's 50% more expensive to buy than rent. Wow. And so if you're a rational actor, you're just much more inclined to rent than buy. I also think the younger generation is starting to be comfortable not owning, especially college educated professionals who tend to value mobility. And by the way, I had this conversation this morning with a client. The notion of home ownership as a driver of wealth, we've been told that again and again and again. But if you think about a purchase of a home, you're putting down 10, 20%. So it's a highly levered transaction. Let's say it's 4-to-1 leverage. And how much return do you get? That's a very risky leverage point versus the historical average in the stock market, which is 9% at a lower leverage point. So before you fall in love with home ownership, what if you didn't put down the 20% and put it in the stock market? Now you have an asset class that's completely liquid, right? Homes aren't. Doesn't have the in and out transaction costs of homes, which tend to be 6 to 7%. You have mobility and optionality, and stock can be gifted, tax free. It steps up. I think that there's a lot of arguments to be made for what we were told versus maybe what might be a better choice. Nonetheless, it's easy to make that choice if you can rent and you get 50% more for your money than the same house, analogous. And by the way, that's one of the biggest underpinnings of why I believe this asset class, meaning rental housing, is so secularly sound. You have a fundamental need for housing, and within that housing universe, you can get 50% more rental than you can home. Well, it's hard to find asset classes with those good of fundamentals. You know, it's difficult. And you also get it now at a correcting price. I think that's interesting. I'm going to move on. Consolidation will shrink the real estate investment industry. This happened in 08 to 10. I felt like this was a very easy prediction. It has happened again, and you've seen it through some of the publicly traded REITs being traded private. Many of you saw that Blackstone bought Air. That cap rate, and there's very, very different ways to view cap rates. It can be in place, it can be stabilized pro forma. You know, we have these conversations a lot, but let's just say they bought it at a 20-25% premium on the stock. Most of the analysis we're seeing is that publicly traded REITs are sort of an implied 5.5 to 6. I'm using 5.8 here. And so that implies about a 5 cap rate going in. I'm sure if there are professionals from Blackstone on this webinar, they would say, well, actually, because of our value add programs and rent growth and, you know, economies of scale, we think we bought it at 5.5. And that would be perfectly defensible. But my point here is it's twofold. One, the public and private markets are very much in sync right now. Our cap rates are plus or minus 5 for private assets. The 5.8 that you're seeing here is more like 5.65, 5.7 because REITs have run up even since this deck was produced, and I'm assuming, you know, NOIs are very similar. They probably haven't in the last 2 weeks. To give you an idea, if you pull up, you know, some of the REITs that I believe are competitors to Origin, you know, Camden, CPT, MAA, They're in similar markets, growth markets, Sunbelt markets. They were trading 10% lower 3 weeks ago. I mean, that's how much this is moving. And there's a remarkably bullish sentiment that's developing in multifamily, and Blackstone taking private air was part of it. There was a big spike in sentiment and public REIT prices, but then the risk-free rate went up and they corrected, and now it's come back down and they're kind of back through their highs. In terms of Blackstone, they've come on publicly, and more importantly, they're investing billions of dollars behind this, saying, I think that multifamily real estate is bottomed, and they're using a lot of the same data that I cited before. I do want to point out, because I thought this was really well said, KKR came out last week, and they're also investing heavily in multifamily real estate. And I just want to use a couple of their quotes because I completely agree with them. From their statement, they said there was a long paper on this that they wrote. They said, quote, "Current challenges of debt maturity and supply are cyclical and not secular." I've obviously been stressing that. Another, "Overpaying in 21 and use of too much leverage and variable rate leverage presents a buying opportunity." I agree. And then lastly, and this is probably most important, quote, "Secular trend is towards more demand." And a lot of that, again, is an undersupply of housing, giant disparity between the cost to own and the cost to rent. I will say, and then I'm going to move to Q&A, the one measure that I don't see yet is you still have to borrow more expensive than the unlevered return. And that's that, so like in 08 and 09, when we were accumulating large positions of multifamily, we were buying below replacement cost, which we liked. We liked the fundamentals. So those two still apply today. We're able to buy below replacement cost, and that's interesting. But the third is we were getting positive leverage on our unlevered return and our cost to borrow. That's not true today, right? So we're borrowing at 6, and our cap rates, even if you're successful in raising rents year one, let's say they're 5 to 5.5. So that's the one that you're uncomfortable with. I would tell you, 2 out of 3, you need to start accumulating because it's a quality asset. I don't think you're going to get 3 out of the 3 in this case. And the big reason is the economy's not dislocated. Like if you think about 09, you had an economy that just wasn't working at all. You had banks being propped up, no lending, a deep recession, and in some regions it was more like a depression. That's not where we're at. And so I don't think you see that. I wanted to talk about one distressed deal just to make it a little bit more real. And then I'll move. And I know I'm a little bit over. I'll be very quick. We've been in discussions. Now we have regional offices. We have 4 throughout the country. And increasingly, we're moving more and more of our 60 people into the regions. So we have offices in Dallas, Nashville, Charlotte, and Denver. And our Denver office has been in discussions, I'll say, with a group that developed a Class A asset in a good submarket. And I have to be broad here in a Tier 1 Western city. And it's taken very different turns. And so as it stands today, their mezz lender is willing to take a deep haircut to their position. They're willing to essentially take a 100% haircut to their equity. But they want a hope note. If we come in and participate, they will keep their construction loan. They're in lease up right now. So this is a built asset, a high quality asset. It's been de-risked, and you're getting development-like returns without taking development risk, and you're much closer to cash flow. So this is an example of what I'm deeming as distress 2.0. Distress 1.0, which was in 2009, we were buying notes from banks. And in certain instances, those banks were failing. It wasn't a distressed real estate situation. It was a distressed economy. banks were fighting for their lives, unemployment was huge. That's not the market we're in. And so if you're looking for distress that looks like that, I don't think it'll happen. But I do think, we're able to buy this if we're able to get the deal done. It'll be 20% below replacement cost, high quality asset. We will have flat to slightly positive leverage. And we believe in the long-term, viability. Like that's what I believe distress looks like 2.0. Okay, so I'm a little bit over, but what I do with Q&A is if you stay on, I'll stay on. I see that we have roughly, I think I see 17 of these questions. So I'm going to start just from the beginning, and you can just keep adding questions. Okay, so the first question, I'm only going to use first names. So thanks for your question, Oliver. Under which presidency would multifamily markets benefit the most? I don't know how to answer that. It's a good question. I do think that qualified opportunity zone extension of that law would be more likely under a second Trump presidency. And the only reason I'm saying that is it was part of the 2017 tax bill, and President Biden hasn't extended it. And so I would think that it would be more likely to be extended since that was Trump's bill if he were president. President Trump tends to be, he's a tax lowering president, which tends to help business and the economy. President Biden tends to be a spender too. These are all, unfortunately, all of these things cause bigger deficits, whether you cut taxes or are into, the spending realm. But they also both stimulate the economy. So make no mistake, the CHIPS bill, the inflation fighting bill, which really was an infrastructure bill, that has created GDP. Government spending is a direct input into GDP. So it's unclear to me. And then, in terms of their policies on trade, it's very interesting. President Biden was very critical of the tariffs that President Trump had on trade, but now he's just created tariffs himself. So they seem fairly similar there in their policy with trade in China. Brent, thank you for your question. His question is about fund investors. Has your NAV share price been reduced to reflect lower multifamily property pricing? The answer is yes. If you're an income plus fund investor, you've seen that the share price has remained relatively flat over longer periods of time for the last 12 months. And you're still getting the dividend, right? So you still are getting that 6% dividend. I'm a large income plus fund investor, but I just made a significant investment into the fund because I'm so comfortable with the share price. We have been lowering our valuations, and we do that by raising the cap rate. Obviously, when cap rates were 3.5, we never valued the fund there, but we did value it at 4, and now it's valued at a 5.25. In some instances, 5.5. So I think it's very fairly priced. But in general, in all of our funds, we do that. We're committed to full transparency, and if you're in QOZ or Growth Fund 4, we also change our expected return ranges. And just know, if you're an investor, this is a journey. I mean, they can go up, they can go down. In the last year, they've gone down slightly, but it's not over. And I believe in the secular trend here. I think everyone is going to do quite well. If you're not in the funds, I think it's a great time to start scaling in, if not to our funds, into real estate. If you've been heavily invested in NASDAQ, for example, pensions and endowments, they're rebalancing right now. It's what they do. And so by definition, they would be selling NASDAQ because it's had a huge run, and they'd be allocating to other areas where, there hasn't been. And I would encourage you to view your own portfolios similarly. By the way, it works in reverse. In 2022, when the NASDAQ was down 40%, and real estate wasn't, that's also an opportunity to sell real estate and buy into NASDAQ. Ultimately, you either have an RAA or you have to function as your own CIO. Third question, I apologize if I don't pronounce this right. Mehdi, it says, regarding your slide on historic completions with 644,000 units, how does it compare to the overall population increase? We'll get back to you with our research. Just email me. Our research team will answer that. All right. I'm having difficulty steering here, but I can figure it out. All right, Robert, thank you for your question. He says, I believe interest rates are dependent on other factors. You have to focus on those outside forces. What data points do you look at to assess where inflation is headed, and thus what rates will do? Robert, one of the things that I believe is that CPI, which is really what we're talking about, how inflation is measured, about a third of that index is the cost of housing, which is determined through the cost of rents. That's how CPI is. They don't look at your home pricing. It's the rent equivalent. And that's a lagging index. And that's actually putting pressure. It's reducing CPI right now because flat rents in 23 show up in the lease roll every month. And so they're renewing flat, and that puts pressure on CPI. That's good, but I also, if you heard what I said earlier, I think the fundamentals secularly are too strong that rents are going to turn around. That's what's going to make multifamily very attractive as an investment. Unfortunately, it's also going to create enduring upward pressure on CPI that will show up in 25, 26, as these rent rolls start to reflect this. It's a third of the index. And so a lot of what I'm basing my assumption on is you have to find a heck of a lot of other deflationary forces in CPI, because I'm convinced that rents will be going higher. And so unless you find enough of the other stuff that goes down, it's going to be really hard. And I just see too many labor deals getting done that are kind of long term. I'm in Chicago. There's a union here that's asking for 9% increases. I'm not saying they'll get them, but they've been very successful in the last 10, 15 years. They're asking for 9% annual wage increases. And so even to ask for that it's amazing. But yeah, that's the environment we're in. Kevin asked a question. Does Origin have a view on what cap rate Blackstone paid? I think I covered that, Kevin. I think they believe they paid a 5.5, and I don't know enough information on the portfolio, but given where they had to pay the premium to the stock of about 20-25%, it's probably in place a 5, but they probably thought it was higher. Greg asked a question, are you looking at any public market real estate? I'm not. Greg, I do for myself. REITs got really cheap. CPT bottomed at about 82, 83, and I did buy a decent amount for me. But I'm not, I don't think we have that mandate at Origin. I don't think that you hired Origin to buy public REIT stocks for you. I think you hired us to find really interesting private investments, whatever that risk spectrum is, whether it's credit, development, own and operating assets, et cetera. So I'm not comfortable doing that. If we've ever had a fund that clearly had that mandate, I think that we have interesting information. I'll give you an example. When we were seeing inflation in insurance, which was extraordinary in 23, I don't think the public REIT market knew it. They just hadn't, the analysts, they hadn't processed this. They're too far away from the data. And, we talked about it, and we were talking about how we thought they were overvalued. So in that case, we just shied away. They were trading, CPT was about 107 when we had that conversation. And then fast forward 6 months, it bottoms at 82 and it's turned around. So I do think we're set up to do that, but we don't have a mandate, so I'm not comfortable. Joel asked a question. I attended the Oregon Design Conference, great insights from architects. They need to meet you. Email me, thank you. I'm happy to be. No, in all honesty, Joel, we're constantly looking at ways we can create more value for the renter through design. And so, of course, that would be interesting. Kai asked a question. Recently, some of the markets that went up, Austin, Tampa, are facing downward pressure. Do you believe this is a short run or persistent phenomenon? I think it's short run. There's a lot of supply hitting right now. Those markets in a secular, longer term way are going to do incredibly well. And this is an opportunity to invest at much, much better pricing in those markets. So Phoenix, the same. I think these are all markets that you should be looking at, Kai, right now. Oftentimes the market doesn't know. If you're a stock investor, if you take a growth investment, I'll give you an example. Amazon in 2022. Amazon's a great company, but they went through a period where they had built too many warehouses and they had some overcapacity through the COVID era, and they had some flat to negative quarters. And the market doesn't know how to then price the company at all, because it had this growth rate over time, but now it's negative for a quarter. What do you do? Because they had it out, growing at some percent. I don't know what it is, but for 10 years, and then they're NPVing it back. So Amazon goes from 200 to 100. Well, where is it now? 200, right? I feel similarly about Austin, similarly about Nashville, similarly about Tampa. I'm not saying this is the low. I'm saying you should start getting in the way. I think you're in a distribution towards the low. Robert asked a question. What do you foresee commercial real estate debt coming due? It can't be refinanced. The impact on the banks. This is the train everyone sees but hasn't really hit. And in particular, it's in office. Office has a problem with higher interest rates, but more importantly, and this is what's fundamentally different about multifamily and office, is their demand curve change. We're having this wonderful webinar across the country with 1,000 investors and partners, and it's all virtual. And this is what office is competing with in every form. So their demand curve is lower. And then the real problem with office is it was totally mispriced. So, before COVID hit, quality office assets were trading a 5 cap. They were trading almost, maybe lower, 4.5. So a mispriced asset whose demand curve moved and debt went up. And so I don't see a solution for those assets. And if you're invested in them, you do have to do the research on whether it makes sense to invest more capital. If you get a capital call, you should be thinking about whether that's a worthwhile use of that investment. Lauren asked a question: how does it make sense to buy at a cost of capital below unlevered return when bonds are at 5.5%? A great question, and I'm not telling anyone to do anything. It doesn't make sense to have an unlevered return above your borrowing rate. I said as much, but you are buying below replacement costs into an asset with enduring demand that has produced very high returns for 50 years. So if you're looking out, just to use the logic, if you want to buy bonds at 5.5%, first of all, bonds at 5.5% have risk. The risk-free rate is not 5.5%. So if you're buying a muni, there's risk in that municipality. There's some unit of risk there because the risk-free rate is 4.37%. But let's just assume that 5.5% you believe is very low risk. You're also getting taxed at ordinary income on any bond. You have no depreciation, no shelter. So let's assume you're a 35% tax investor. You're getting 4% after tax. But in real estate, you're probably not going to get taxed because you do have these amazing tax shelters in real estate. And typically it's grown at 8%, 9% over long periods of time. So on an after-tax basis, if you're looking long-term, you're going to do a lot better over longer periods of time. If you want to be in credit, which I think there's a huge place for credit in every portfolio, I would rather be in our credit fund. We're getting 10 to 12%. And I'm a really large investor in strategic credit. I really believe in the safety. I reinvest the dividends, but you could have monthly liquidity if that's the need of the investor. Okay, next question, Richard. We live in Brunswick, North Carolina. There's a new apartment construction. Brunswick is the fourth fastest growing county in the US. Can you check on this and see how it squares with? Of course, just email me, Richard, and we'll run Multilytics. It'd be more helpful if you send me an address because we go down to the address level of the apartment community that it sounds like, interested in investing in. Sebastian asked a question, what are the risks we could face in the near and long-term future for development? There's always risks in development. That's why you get paid an inordinate margin, presuming it works. And probably the biggest risk always is construction cost, because that's a risk that we should be controlling as developer. I think that risk is pretty low right now. And there was a question emailed in prior, which I'll address, sort of answering your question, Sebastian. I don't think it's likely that construction costs have in terms of distribution, I don't see that distribution as being very risky, meaning you're going to have a 10% overage in construction. There's not enough new development happening, and the subcontractors are getting a little bit more, I don't want to use the word desperate, but they're much more proactive in their bidding and willing to come down, not up. It is regional. For example, in Florida, we see construction pricing coming down, but in Phoenix, it isn't. And a lot of that, it's not going up, but it's not really coming down. A lot of that is actually where these government subsidized projects are happening. And so if they're, in Phoenix, there's large government subsidized infrastructure and chip development. And so, it's using a lot of that construction capacity. In Florida, it's very home driven, and there's not enough new construction creating demand for this labor. So I don't see that distribution being troubling at this point. James asked a question, will there be any rate cuts at all this year? Oh, great question. I think when I wrote in November, I believe I said 1 to 3 rate cuts, which was extraordinarily bearish relative to consensus. I'm gonna kind of tighten that up, and I'm gonna say 0 to 2. And I apologize if that's too wide, but I'm gonna say 0 to 2. There has been some talk of rate increases. I don't believe that will happen. Joseph asked the question, with the example of distress you discussed, what kind of return are you targeting? So first of all, that will most likely be a sidecar for our investors because we don't have a purely distressed fund if we do it at all. And then secondly, it'll be mid to upper teens returns for, you're buying built real estate, and the only risk you're taking is lease up and refinance risk. It's already built. And the opportunity here is, if you think about the old capital structure, if there was 20 million of equity and 10 million of mezz, the mezz is taking a haircut, the equity is being wiped out. So you're coming in at a basis, 25 million below where they had to capitalize the project originally. Tony asked a question, given the current economic situation, what's the best asset class to buy or invest in? I don't know how to answer that. In my opinion, again, view your portfolio as it's a living, breathing, evolving thing. And whether it's your advisor or yourself, it does need to be adjusted. And so if you have parts of the portfolio that have really done extraordinarily well, you should rebalance them with parts that you probably want more exposure to. Another story I'll tell is, if you think about energy investing, energy was just a horrible asset class for a long period of time, 3 to 5 years, and energy prices were low, but you also had all the ESG, and there were all these funds saying they, BlackRock came out and said we're not going to invest in any non-ESG, and that's the sentiment that was there in 2021, and then it completely changed, and it became one of the hottest areas. So I think you have to rebalance, and you need to view your portfolio as something that's evolving, and not just forget about it. Paresh asked a question. Goldman Sachs started a real estate fund, raised 4 to 5 billion. Do you believe that further validates go on offense? Not really. I mean, Goldman is definitely, they're very smart people, and that's fine. But no, I think they raised a fund because they're trying to meet demand from their clients, and they want to grow. So I wouldn't look at that as a buy indicator. I do think that what Blackstone did is notable, and it wasn't just air. They also did another transaction prior to that. I mean, they're going in deep, and have been, candidly. BREIT is heavily invested in multifamily. That isn't by accident. That's their core thesis of the best real estate to be in long term. John asked a question. Interesting discussion. If your predictions don't come to pass, what might be the reason? Of course, John, no one can predict exogenous shocks. And so if something odd were to happen, I'll name a couple. A widening war in the Middle East that affects the global economy, a trade war with China that escalates, the economic cycle itself. I'll paint one. The historic average of recessions that follow rate tightening cycles over the last 50 years has been 26 months. So as we sit here today, we're at about 26 months. And I could make the argument that because the Federal Reserve balance sheet was so big, and the federal government had written so many checks to people through COVID, that the cycle of 26 months should be delayed. It shouldn't take 26 months. It should take 40 months, because we had more money to start with in the economy and in our own pockets. And so if you believe that, and you believe that a recession is coming, it's just going to take longer to get here, that's very counter to the belief today, which is generally there's going to be a soft landing, or a somewhat soft landing. Those are kind of the two camps. I haven't heard a lot about recessions. And so I think it's plausible that could happen. And that's not all bad. Typically in recessions, our interest rates go down quite a bit, which is much more, it has a bigger effect on multifamily probably than even the recession and the operational impact. So it's very complicated, but that would be a big one. It's been a long time since we had a recession. The COVID recession was very brief. And you could also argue that the new Federal Reserve policy is, I would call it quasi-capitalism. And that sort of started in '08, and it was perfected over time, and COVID's the best example. But with QE and the development of their balance sheet and rate cuts and all the things they do now that they just candidly didn't do until the Great Recession, they haven't shown me that they really want there ever to be a hard landing. And until they do that, I'm going to have to assume that's the new policy. Last year is a great example. When the regional banking crisis happened, SVB Bank failed and Signature Bank failed, and the regional banks were in free fall. And the Fed was in the middle of a tightening policy stance. That was largely what caused it, because these banks had made foolish investments in fixed income securities looking for 30 basis points of yield, and then they blew out 300 basis points. I mean, that's what happened. But the Fed came in, even in a tightening cycle, and said, hey, we're gonna make all this collateral good, i.e. we're not gonna have a bank run. And they stopped it immediately. They're not really ever willing to let the market play out. So until they show me that they are, it could be that we're just in a new era, and it kind of feels like we are until that changes. Alex asked the question, will Origin start looking at distressed assets? 100%. We have been looking at them for a year. We pass on hundreds of deals for different reasons. We're currently looking at one distressed deal that meets our criteria. And so you asked about metrics. I tried to cover them: replacement cost, operational growth, and positive leverage that we can generate through the buy itself. In this case, the asset we're looking at, we're one of one groups. There is no competition. It's fully off market. That's why I couldn't talk about it in detail. Or we can build the cap rate through our own operations. Okay. I can't tell how many people are on this platform. So, okay, I'm almost done. We have 4 more questions. Sean, what is your target segment to invest in your funds, and how are you targeting those investors? Please email me offline. I don't understand the question, but you have my email, and we'll send you the deck. And Kit asked a question, how does the hospitality market look like overall? I'm not an expert on the hospitality market, so I can't comment on that. I think that it's highly cyclical, and the economy is very strong and travel is very strong. So it's likely that you're looking at pro formas that are stretched at this point in the cycle. So I would, just in the same way I see asymmetric ways to win in multi, I'm being very broad. And ultimately, if you're looking at a deal, it's very idiosyncratic. But in a broad way, I would be nervous about downside distribution in hospitality from here. Joseph asked a question, in the distress example, how then do you determine who gets the opportunity to invest? So Joseph, if there's there's more demand than the amount of equity we have in the deal, it will be allocated based on the client and how long the relationship is and how large the relationship is. So if clients are, a small partner at Origin and they want to put a lot of money into one deal, that would be unlikely to happen. But if you're a large client, then it would be more likely to happen. And, I advise clients on that all the time too. If you have $100,000 in a fund, you should not invest $300,000 in one deal. That isn't good. Just like if you had $1 million in the S&P, you shouldn't put $3 million in Apple, right? And it's no different. So I oftentimes advise clients, please think about funds first, and then the deal level investing should be proportionate and less than your investment in a fund. Last question, Bruce, is Income Plus generating enough cash flow to cover distributions? How much of that is tax sheltered? I believe last year, I want you to email me because I want to be absolutely correct, but I believe it was 95% sheltered last year. But I will make sure, email me at david@origininvestments.com. Okay, so that is all the questions, I think, and I appreciate your time. I hope that it was time well spent. Everyone will receive the recording as well as the deck, and we will talk to you very soon. Hopefully, some of you will have interest in the 1031 exchange platform, which we have a webinar on next week at 1 p.m. Have a great day. Bye.